Leverage is probably the most misunderstood concept in all of retail trading. It's the thing brokers love to advertise. 500 to 1 leverage, 200 to 1, like it's a feature, like more is always better. And it's the thing that, when used without understanding it, absolutely destroys beginner accounts faster than almost anything else. So in this video, we're going to cover exactly what leverage is, how margin connects to it, how to calculate your real exposure, and most importantly, what the actual risk looks like, both sides of it, not just the exciting part. I'm not joking with you when I say, you 100% need to know this stuff before you ever put $1 into the market. The amount of people that don't actually understand anything about leverage at all and are out here gambling is absolutely insane. But not you. We are going to save you from joining that collection of people right here and now. So buckle up. We are going to start from scratch. Quick disclaimer before we get into it. Everything on this channel is for educational and entertainment purposes only. Nothing I say is financial advice. Any decisions you make in the financial markets are entirely your own responsibility. Please do your own research and never risk money you can't afford to lose. Okay, so what actually is leverage? Leverage is borrowed capital. It's your broker allowing you to control a position that's much larger than the amount of money you actually have in your account. Here's the simplest way to think about it. Imagine you want to buy a property worth $200,000, but you only have $20,000 of your own money, so you take out a mortgage for the remaining $180,000. You now control a $200,000 asset, but you only put in 10% of that yourself. That's leverage. You're controlling something much bigger than your own capital would normally allow. In forex, it works the same way, just with currency instead of property. And the numbers can be far more extreme. If your broker offers you 100 to 1 leverage, it means for every $1 you have in your account, you can control $100 in the market. So with a $1,000 account and 100 to 1 leverage, you could theoretically open a position worth $100,000, a full standard lot. Now that sounds incredible on the way up. And that's exactly how it gets sold to beginners. But here's the part that matters. Leverage amplifies everything, not just your profits, your losses too, exactly equally. Let's use real numbers. Say you have a $1,000 account. You use 100 to 1 leverage to open a $100,000 position on Euro USD. You're controlling a standard lot. The trade goes against you by just 1%. 1% of $100,000 is $1,000. Your entire account gone, wiped out by a 1% move. And 1% moves in forex happen all the time, sometimes in minutes. That's not a made-up scenario. That's exactly what happens to the traders who don't understand leverage every single day. Now contrast that with someone who understands leverage and uses it carefully, same $1,000 account. But instead of maxing out their leverage, they open a micro lot, 1,000 units, 1/100th the size. Now, a 1% move against them costs them $10. They can weather that, they have room to breathe, they can let the trade play out. This is the core lesson. Leverage is a tool, and like any tool, a power saw, a scalpel, a fast car, in the right hands it's enormously useful. In the wrong hands, it causes serious damage. Now let's talk about margin, because leverage and margin are two sides of the same coin, and people often confuse them. Margin is the amount of money your broker requires you to set aside as collateral to open and hold a leveraged position. It's not a fee, it's not a cost, it's a deposit that gets held while your trade is open and released back to you when you close it. The margin requirement is directly linked to your leverage ratio. If you have 100 to 1 leverage, your margin requirement is 1%. That means to open a $100,000 position, you need to have $1,000 set aside as margin, 1% of the full position size. If you have 50 to 1 leverage, your margin requirement is 2%. To open the same $100,000 position, you'd need $2,000 as margin. The higher the leverage, the lower the margin required, and the lower the margin required, the easier it is to overexpose yourself without realizing it. There are two terms you need to know here, used margin and free margin. Used margin is the amount currently locked up as collateral for your open trades. Free margin is what's left over, the money available to open new trades or absorb losses. And then there's something called a margin call. This is what happens when your losses eat into your margin to the point where your broker steps in. If your free margin drops below a certain threshold, usually somewhere between 20 and 50%, depending on your broker, you'll either get a warning or your positions will start being closed automatically to protect the broker from you going into negative balance. Nobody wants a margin call. It's essentially your broker telling you that your account is in freefall and they're pulling the handbrake. The way you avoid it is simple but absolutely non-negotiable. You never risk so much on a single trade that a bad run of losses can wipe out your margin, which brings us directly back to position sizing and risk management, topics we're going to cover in depth in upcoming videos. Let me show you a simple way to calculate your leverage exposure so you always know what you're actually dealing with. The formula is straightforward. Take your position size in units and divide it by your account balance. So if you open a mini lot, 10,000 units, and your account balance is $1,000, your leverage exposure is 10,000 divided by 1,000. That's 10 to 1. You're using 10 times leverage. If you open a standard lot, 100,000 units with that same $1,000 account, your leverage exposure is 100 to 1. You're using the full 100 times leverage. And as we just covered, that's extremely dangerous at that account size. As a general rule, especially when you're starting out, you want to keep your effective leverage, the leverage you're actually using, not the maximum your broker offers, below 10 to 1. Many professional traders keep it far lower than that. Some experienced traders never go above 5 to 1 effective leverage, even with years of experience behind them. The maximum leverage your broker offers is almost irrelevant. What matters is what you choose to use. Let me quickly address the question I know some of you are already thinking. If leverage is so risky, why does it exist at all? Fair question. The honest answer is twofold. First, forex price movements are relatively small on a day-to-day basis. Most major pairs move somewhere between 50 and 150 pips on a typical day. Without leverage, a retail trader with a small account would make pennies on those moves. Leverage makes forex accessible and viable for people who aren't trading with millions of dollars. Second, and this is just the reality of the industry, leverage is profitable for brokers. Not because they're stealing from you, but because the more you trade and the larger your positions, the more spread and commission they earn. It's in their commercial interest to offer high leverage. That doesn't make it right for you to use all of it. So, to wrap this up cleanly, leverage lets you control a large position with a small amount of capital. It multiplies both profits and losses by the same factor. Margin is the collateral your broker holds to keep your position open. A margin call happens when your losses have eroded your account to a dangerous level. Used responsibly, leverage is a tool that makes forex trading viable for retail traders. Used recklessly, it's the single fastest way to lose your entire account. The traders who last in this game are not the ones who use the most leverage. They're the ones who understand it completely and choose to use as little of it as they need. In the next video, we're going to talk about how to choose a forex broker. Because not all brokers are equal, and picking the wrong one before you even place your first trade is a mistake that costs people real money. See you there.